Welcome back to another episode of The Investment Advisor. I'm your host, Matthew Stevenson, in partnership with Dukascopy TV. Remember, money can take care of you, it cannot take care of itself. Well, today we're going to look at one of the storied names in global finance, that of Goldman Sachs. Started as a partnership more than 150 years ago at this point, I'm sure, Lower Manhattan, and has grown into a banking giant, an investment banking giant, to the point that its capital is in excess of $80 billion, and it's known around the world as one of the great investment banking houses there is. The question is, do you want to own the shares? That's what we always ask our viewers. Do they want to own, do they want to buy, they want to sell, they want to hold the shares? Well, Goldman Sachs shares, you can see here on the chart behind me, trade about $199 a share. It's been quite a ride. As you can see way down here, they've kind of traded up and they've traded down. In the crash, they traded well below 100. Then they came back, roaring back to now almost $200 a share. It's been quite a roller coaster for anybody who's probably worked at Goldman Sachs or owned the shares of Goldman Sachs. Are they expensive? In some measurements, Goldman Sachs is not an expensive stock. It trades at about 10, 11 times earnings. So that's as a measuring stick, it's one I like, not that expensive. In terms of book value, the stock trades at about 1.2 times book. So again, the premium isn't there. But Goldman Sachs doesn't have that many sort of recurring items in their revenue line. They've got to earn it trading. They've got to do it by cutting deals, by brokering mergers and acquisition, by issuing stocks and bonds. So it's a struggle for them every year to duplicate the revenue. Revenue's good, $34 billion, nothing to sneeze at. So with all that, the question is this a stock now back to almost, it's not quite its all-time high, but back from the crash in a very important way that you want to add to your portfolio? My reservations about Goldman Sachs are this. When Goldman Sachs was trading up here in the stratosphere, because it was basically almost an unregulated industry at that point, it was able to lever its book 25 times, which meant take its capital base, multiply it by 25, and that could be the portfolio of assets held on the books of Goldman Sachs, some of which were for their own account, some for their clients too, obviously. Now, because Goldman is a regulated, I believe it's a New York State chartered bank, the leverages have to come down. And the leverages, buildings go up, leverages have come down, and that means that the leverage on the Goldman book of assets is about 11 or 12 times. Well, 11 or 12 times, you're just going to get a constriction of revenue. They've done well, but at 11 times, at 12 times, at 8 times, it's not 25, 20, 22 times that they enjoyed in the go-go years. The other reason about Goldman Sachs is that they tend to reinvest most of the capital that they earn back into their business. Dividend is somewhat small, about 1%, 1.2%. So you're not going to get much of a dividend. Your hope on Goldman Sachs is the guys going into the building there every day know how to get a higher return on investing that money than you do. And that's not a bad bet. I think that's a safe bet. My problem, kind of in conclusion, is are investment banks inherently good investment vehicles for everyday investors? Not convinced. They go up, they go down. Trading revenue is very hard to predict. It's cyclical. And to get in at the right time and to get out of the right time is not something that the everyday investor, even the professional investor, is also always going to get right. I like that Goldman Sachs is a brand. I'm not saying it's the Sears Roebuck of money. I'm not saying it's the Walmart of mergers and acquisitions. It is a brand. It's celebrated by Warren Buffett, among others, which speaks well of it. It's well located in the world, the crossroads of finance. But I think of it as relying on the ability of the employees every day of the year to generate revenue through transaction income. That's not always hard. That's not always easy to do. So yes, it's not that expensive, but will the revenues be there? They could be, but in a downturn, I'm not so sure. So for me, I might hold Goldman Sachs. I would not buy Goldman Sachs, and I'd be tempted at these levels to be selling Goldman Sachs. Well, that's all the time we have today on The Investment Advisor. I'm your host, Matthew Stevenson, in partnership with Dukascopy TV. Remember, money can take care of you. It cannot take care of itself.